How's it going, everyone? Bill Lethman here for Money Evolution. In today's video, I have a question for you. Do you have most of your retirement savings in traditional IRA accounts and traditional 401k plans? If that answer is yes, then I think you're going to really want to pay attention to today's video. Because in today's video, I'm going to be talking about why having too much money in those traditional retirement accounts could pose a huge tax problem for you later on. But real quick though, before I get into the content of today's video, if you're watching this and you're resonating with what I have to say here, and you want to learn a little bit more about what we do at Money Evolution, be sure to check out some of the links down in the description below. There you can learn about our comprehensive financial plan called Wealth Vision, or go to wealthvisionplan.com, and also our retirement planning program called the Retirement Time Machine. You can also go to retirementtimemachine.com to learn more about that. Okay, so if you have most of your retirement savings in those traditional retirement accounts like traditional IRAs and traditional 401k plans, first of all, you're not alone. In fact, most of the people that we see on a daily basis for our financial planning clients, they're in exactly that same position. And that's because those retirement savings plans that were tax deferred have been around the longest. And it wasn't until much later that those Roth accounts came out. And it wasn't even until relatively very recently that the Roth 401k plan even became an option for people saving money through their employer. So if you have these large balances, one of the things we really need to be thinking about is what are the potential tax issues that we could be facing down the road. Let's think about it for a second. So when we first started putting money into those accounts, I think we were all told a little bit of, maybe not a lie, but a little bit of a myth there on how that was going to work out for us. Remember back when we first started putting money into those IRA accounts or your 401k plans, the idea was that you were going to take that as a deduction off of your income taxes, and then you'll pay taxes later in retirement when you withdraw that at what presumably would be a lower tax rate. After all, if we're not working, we're likely going to be in a lower tax bracket. Well, a lot of things have changed since then. So number one, with people having very large balances in these retirement accounts, as that money starts to come out, that could potentially on its own be a very big tax issue. Number two is if we look at some of the historical tax rates, we can see that tax rates over time are actually much lower today than what they've been at other points in history. In fact, actually, if we look back to the period in the 40s all the way through the 50s there, we actually had a very high tax rate, actually approaching or even in some cases over 90% tax table rate. So that's huge. Interestingly, though, that was right during and right after World War II when our debt to GDP ratio was at one of the highest levels ever. Well, surprisingly, or maybe not surprisingly, our debt to GDP ratios as they are today in 2023 are really at those similar levels. In fact, in some cases, I think they're actually higher in terms of debt to GDP ratio that we have here today. So we have this enormous debt. In fact, actually, in 2023, it's actually $32 trillion. And according to the Congressional Budget Office, they're projected to have almost about a $2 trillion a year annual deficit, which means that 10 years from now, we could be looking at a $50 trillion debt. So that's just a huge number. And at what point do these tax rates start to go back up and we have to start paying some of that debt, or at least paying for some of the debt servicing? With interest rates going up, the cost to service that debt is also getting a lot more expensive. So those are some of the things we need to think about there. And then if we look at even other things that we know in terms of today, we actually have two tax tables. We have the tax tables that we have today in 2023. Those were put into effect in 2017 or went into effect in 2018. And that was the Tax Cuts and Jobs Act rates, which created across the board pretty much lower tax rates for almost every tax filing category. Well, those tax rates are set to sunset, and then in 2026, we're going to revert back to our old tax table. Now, there's probably going to be some adjustment for inflation here, which is what I did here. So we have our current tax rates, and we have the tax tables as they are going to be potentially in 2026 with an adjustment for inflation. So we can see, for example, and we've talked about this in a lot of other videos, that 24% tax bracket that we have today for a married filing joint tax return goes all the way up to $364,000 of taxable income. The 28% tax bracket, just to give you an idea, this is inflation adjusted, only goes up to $269,000. So we have almost an extra $100,000 of room in the tax bracket And instead of being at 28%, we're at 24%. In fact, actually, that next $100,000 would actually go into a 33% tax bracket. So one of the things we've talked about in a lot of other videos is, what is my tax bracket today versus what is that tax rate going to be in the future? And that's going to be something very important to do as we work towards working on tax optimization. And as you're thinking about the money that you have saved for retirement, that's going to be very important, because remember, whatever you have saved up in those traditional retirement accounts is going to eventually be taxed. You're either going to be paying taxes over your retirement or your lifetime. If you die and that money goes to your kids, they'll pay taxes on that. And then also at now age 73 or age 75, depending on what year you're born, something called the required minimum distribution rules are going to kick in, and whether you want to or not, the IRS is going to start forcing you to take some of this money out of those retirement accounts. And that's really one of the big things that I want to get into a little bit today, and helping you to understand is what are those required minimum distributions. And with everything else that you may have, probably Social Security benefits, maybe a pension, other things that may be going on from a tax standpoint, and then adding on what could potentially be some very large required minimum distributions, is that going to maybe push you into a higher tax bracket at some point later in your retirement? Okay, so again, that key to all tax planning really is going to be understanding what is my tax bracket today versus what do I think that tax bracket is going to be in the future. And really the first step in this is really to know exactly where you are in the current tax bracket. So these are some reference guides that I created as part of our Retirement Time Machine program here. And we're going to use the one on the left, which is going to be our current tax table. And this is going to be the one for married filing a joint tax return. We've got the guides for people that are filing single, head of household, and things like that. So if you have, let's say, taxable income of $250,000 for 2023, and that's after your deductions and everything, we can see that we're going to be over that 22% tax bracket of $190,000, but we're still going to have about $114,000 left in room in that 24% tax bracket. And that's what I've said in many other videos, that I really think is sort of the sweet spot for these current tax rates that we have right now, the Tax Cuts and Jobs Act rates, is that 24% bracket, which really just kind of created this Grand Canyon-sized opening there. But we can also look ahead and say, okay, if you're still working, let's say, you and your spouse, and you're maybe 5 years out from retirement or whatever, you can kind of plan out what you think maybe some of your income is going to be in the future. But we can see right here that $250,000 of income, if you were reverting back to that old tax table, is going to push you up into that 28% tax bracket. So again, I think our tax arbitrage situation would be if we can pay taxes today at a lower tax rate than what we think it's going to be in the future, that's where we're going to have some advantage. But understanding what these tax tables are, where you are in the tax tables, what they might be when they revert back, not to mention what they might be if Congress enacts some new tax legislation that might make taxes higher for everybody as they think about ways to kind of pay off the debt. Social Security has been in a deficit here for now many years and is running out of money. There's something that needs to be done with Social Security benefits as well. But you want to be thinking about that, where you are, and then also kind of looking out into the future. And this is something we do in our program, is looking at where your asset buckets are going to be. So this is something that's fairly typical, and it may be typical of your situation as well. This is from our eMoney software that we use in our high-end financial plans, but also we help people through the workshop and the Retirement Time Machine program build out their own eMoney portal, where you can see things like this visually and really get some good long-term projections here. But basically what this is showing is what we call assets by tax type. So you have essentially three different categories that you can have money invested. You can have what we call sometimes non-retirement accounts or taxable assets, things would be brokerage accounts, your bank accounts, things like that, things that don't have any tax advantage from a tax standpoint. We have tax deferred, which is what we're really talking about here in today's video, and that's going to be representing this light blue color right here. You can see this individual hypothetical situation has most of their money in this tax deferred area. And then also you may have have some Roth money, which on here is called tax-free assets, and that's going to be represented by the orange. So you can see where this sort of goes over the long run, and you can see what these buckets are. Why that's going to be important is because that's going to be what's going to really drive the required minimum distribution. So one of the other reports that we have in here is the cash flow report, where we can see, depending on your age, either age 73 or 75, depending on what year you were born, you're going to have to begin taking those required minimum distributions. And we're going to see not only what those distributions are, but also have some projections on what they might do from an income tax standpoint. So if we look at this, a couple of our other reports right here, we can see things like this, which is our tax charts that we have. And we can see, first of all, a quick visual of what that looks like. This is an example here with our hypothetical couple here. They're working for another 3 years, including this year, so we see some pretty high taxes here, but we also see some low tax rates here in the early part of retirement. That's something we've talked about in a lot of other videos, but identifying those low tax years and then what are some of the opportunities that you could have. But we can see that over time, these tax rates really start to come up. So we can also look at what that taxable income tax base is, so the amount that's actually hitting your tax table. So we can see this kind of fits right in with what we were just talking about a minute ago with the example, and that's their taxable, do that in the wrong spot, but the income tax base rather is about $233,000, $247,000. So they have about $100,000 of room in that bracket, but we can see sort of long term where those future income tax base numbers are. So we can use another chart that I created and look at the different tax rates and how they might be adjusted for inflation going forward. So we can come up here and say, okay, according to our report that we have in 2034, we think we're going to have $250,000 of income, so we can see, okay, well, that is pushing them into the 28% tax bracket if in fact they have $250,000 of income in 2034. So it helps you to kind of put the whole thing together and really answer some of those biggest questions that you might have is, how do I optimize this? How do I really make this have something that we could, really put together some ideas that are going to help you for your retirement? So as you're kind of going through some of this, there's going to be a few action steps that I think that you can take that are going to help you to optimize some of your resources for taxes here. So one is you have to identify where your tax rates are today versus the future. And if you have room in the current bracket, there's going to be a couple things you can do. Number one is you can change where you're making your contributions. So if you have, let's say, $100,000 of room between now and the top of the 24% tax bracket, you could change things up. Instead of taking that pre-tax deduction, you can put that into the Roth instead. And so that's going to raise your taxable income, of course, but it's going to be hopefully better for you over the long run, because we believe that you're going to be in a higher income tax bracket later because of that. And then number two, we could do actually some conversions. Okay, so that's going to be something where you can take bigger chunks of money and move that over from a traditional retirement account to a Roth. And there's a number of different ways to do that. Some 401k plans allow you to do an in-plan 401k traditional to Roth conversion. Some of the times it has to be done in an IRA, so you do a Roth or traditional IRA account to a Roth IRA account would be through doing conversions. Now, if you're not 59 and a half, you want to be very careful and make sure you have the money in some other type of account to pay the taxes on those conversions. Otherwise, you could be in a penalty situation if you need to take the tax money out of one of those retirement accounts. So be careful on that, but that's number two. And then the third piece of this really goes into something that is a much bigger conversation, but that's going to be the withdrawal plan. So a lot of times if we go back to those asset breakdown, as somebody goes into retirement, this individual doesn't have a whole lot of money in those non-retirement accounts, but sometimes if people have done a pretty good job saving and they've got a lot of money that's in that taxable asset category, they may choose to live off of that for a few years. And they're saying, hey, isn't this great? I'm taking this money out of those taxable assets there, and I'm paying very little tax on that money, maybe just a small amount of some capital gains potentially. And they end up in a situation where they're in these very low tax rates here for a number of years. And then all of a sudden, one of a couple things happens. That money runs out, and that's what is projected to happen here for this individual. And now they're saying, okay, now all of my money is in this traditional retirement account, and now every dollar that I take out, every dollar that I need for retirement is going to be taxed at whatever the income tax brackets are for that year. So that's one thing. The other thing is, of course, what we've been talking about is the IRS has a plan for us too. So we want to create our own withdrawal plans and our own tax plans and not rely on the required minimum distributions and the plan that the IRS has, where all of a sudden we're going to say, hey, we're going to have to start taking all this money out, and it's going to push us up into a higher tax bracket. So think about this as we kind of wrap up here today. Find a blank screen here. But let's say that you have $1 million in a traditional retirement account today. And obviously, we're going to say maybe you're adding to it, maybe you're not, but we'll just say just some simple numbers here using the rule of 72. So the rule of 72 is a neat little trick that tells us how long it's going to take for something to double given a given interest rate. So if we divide, let's say, 7.2% into the number 72, that means it's going to double our money every 10 years. So we'll just use that as an example here. And so if we're 55 today, that means that $1 million will double to $2 million by the time we're 65. And by the time we're 75, which is going to be the age that our required minimum distributions are going to kick in, we could have $4 million in that account with a 7% growth rate. Now that may be, you think that's too high or too low or whatever, but you kind of get the idea that as time goes on, our accounts are hopefully going to be growing, and as that money that's in those traditional retirement accounts grows, that is always going to have that tax bill attached to it. And remember, the IRS or the government gets to decide what that tax rate is. So if they enact new legislation, they can come along and say, hey, the tax rates are going up. In fact, actually, from 1986 to 1996, a lot of people don't even know this. No, 96 there, okay. From 1986 to 1996, for that 10-year period, there was something called a excise tax, and it was a 15% tax or penalty, whatever you want to call it, on top of whatever the tax rates were for your distribution on a retirement account. If it was deemed to be too large, if you were over certain amounts, they were going to tack on an extra 15% penalty. Now that fortunately went away. I'm not saying I think it's coming back. I haven't heard anybody talk about it coming back. But as this government debt mounts and they are continuously looking for ways to try to balance the budget or bring that debt down or whatever you want to say there, that $32 trillion that we owe, is there going to be a time at some point when they come along and say, hey, people that have $1 million or $2 million or $5 million in an IRA account, those people are very well off, and we're going to tax that more. So those are the things that could potentially happen there. So those tax rates, I think, more than likely are going to have to go up in the future. So having a good tax strategy and a good tax plan, I think, is definitely a smart thing. So anyway, I hope that's been helpful. I kind of went through that a little bit quickly, but hopefully it's given you a few ideas. And if you want, again, to find some ways that we might be able to help you, check out some of the links down in the description below. The Retirement Time Machine program that we created, really you're going to see a lot of those same worksheets and things that I went through here today, with the ability to create sort of a DIY financial plan, retirement plan that's going to show you year by year what's happening with your retirement situation, helping you to understand your gaps. That helps you to create your retirement withdrawal strategy, some forward-looking projections on the income taxes, so you can see very clearly what is your tax rate today versus what is that tax rate going to be in the future, your required minimum distribution. So you can start to kind of put this together and see how all of these different pieces of your retirement come together. So anyway, with that, hope you enjoyed the video. Be sure to hit that like or subscribe button. Check out the links below, and I'll see you back in our next video.